So before we start, here's how this video works. When I move, the video speeds up. When I stop, we learn. Each section you're about to see represents one core idea, and together they make up episode 6, which is our full walkthrough of borrowing costs under IAS 23. The builds are simple on purpose. They are not decoration. Each one is a visual anchor designed to help you remember how the standard works in exams, not just what it says. We'll move through 8 sections, one at a time, and when each section is done, we move on. No mixing, no overloading. And by the end of this video, you should be able to look at any borrowing cost question and immediately know whether does this get expensed or capitalized, when capitalization starts, when it pauses, and when it stops. So let's start with the core principle. The core principle of IAS 23. At the heart of IAS 23 is a simple idea that borrowing costs form part of the cost of a qualifying asset if and only if they are directly attributable to getting the asset ready for use and sale. Borrowing costs are the cost to borrow money, such as interest, finance charges, and lease-related finance costs. But IAS 23 does not say that all borrowing costs are capitalized. Most borrowing costs go straight to the statement of profit or loss. Only borrowing costs that are linked to a qualifying asset are added to that cost of that asset. This is important for exams because as a student, we often think that if there is a loan, capitalize the interest. This is wrong. The loan must be linked to the qualifying asset and the process of acquiring, constructing, and producing that asset for it to be capitalized. So here's a mental checkpoint. If there is no qualifying asset, IAS 23 ends immediately and you expense the borrowing cost immediately. So let's move on. Scope and what IAS 23 does not apply to. Next, let's talk about the scope. IAS 23 deals with the accounting of borrowing costs, but it specifically does not apply to certain assets. IAS 23 does not apply to inventories that are manufactured or produced in large quantities or on a repetitive basis. In other words, normal inventory production does not qualify. Why? Because those inventories are not taking a substantial period of time to get ready for the sale or use in IAS 23 sense. They are part of routine operations. This matters in exams because markers want to see that you can exclude items just as confidently as you can include them. So here's a mental checkpoint. If it's repetitive inventory production, stop IAS 23. IAS 23 does not apply in those situations. Now let's move on. Borrowing costs. What they include. Now we define borrowing costs. Borrowing costs are the interest and other costs incurred in connection with the borrowing of funds. This includes interest expense calculated using the effective interest rate under IFRS 9 and also finance charges on lease liabilities. So borrowing costs are broader than just the interest on a loan. So if you are leasing equipment, that lease creates a finance charge, and those charges are borrowing costs. This is important because exam questions often hide borrowing costs inside of leases. So if the lease is linked to the construction of a qualifying asset, those finance charges may be capitalized. If not, they are expensed. Again, a mental checkpoint here is that borrowing costs are equal to the interest plus any finance charges related to the borrowing, not just bank loans. Let's move on. Qualifying assets. A qualifying asset is any asset that necessarily takes a substantial period of time to get ready for its intended use or sale. In practice, this means that more than 1 year It takes more than 1 year. Examples include constructing a building that takes more than a year to complete, or using a leased truck in the construction of a building. The related borrowing costs of the truck may be capitalized to the land and building. This section is very critical because if the asset does not take a substantial period of time, you cannot capitalize its borrowing costs, even if there is a loan. A mental checkpoint: if there's no long construction period, there's no qualifying asset, which means that you expense the borrowing costs. Let's move on. Capitalize versus expense, the three conditions. Now we answer the biggest exam question. When do we capitalize borrowing costs? Borrowing costs can only be capitalized if three criteria are met. The first is that it's directly attributable to the qualifying asset. The second is that it's probable that future economic benefits will flow to the entity. And the third is that costs can be measured reliably. If any one of these is missing, you expense the borrowing costs. But there's more. You only start capitalizing once all three of these operational conditions are met. The first one is that if expenditure on the asset is being incurred. The second is that borrowing costs are being incurred. And the last one is that activities necessary to prepare the asset for its use or sale are in progress. These are the three operational conditions, and they need to be met to start capitalization. So you don't start capitalizing interest just because a loan exists. You capitalize interest when construction has actually started. So as a mental checkpoint, a loan alone is not enough. Activity must be happening. Let's move on. When to stop and when to pause. Capitalization does not last forever. You stop capitalizing borrowing costs when 1. Substantially all activities necessary to prepare the asset for its intended use or sale are complete, or 2. If only minor work is remaining. And you pause capitalization during 3 conditions, for example, when there's extended periods where activity, or rather active development, is interrupted. 2. Any unplanned or abnormal stoppages. Or lastly, any interruptions outside of management's control, such as bad weather or a thunderstorm that lasts days or whatever. Then you'd have to pause capitalization. This is examinable because us as students, we often forget when to stop or pause capitalization. So another mental checkpoint here is that active construction drives capitalization. If there's no activity on the ground, no capitalization can happen. Let's move on. Specific borrowings and interest to capitalize. Now let's talk about specific borrowings. A specific borrowing is a liability taken out for a specific project. The full loan amount is transferred on day 1. Interest is charged on the full amount, even if not all funds are used immediately. The amount of interest to capitalize is the interest incurred minus the interest income earned. Interest income arises when unused loan funds are temporarily reinvested into other assets. This is important because you do not recognize that interest income in profit or loss. It just reduces the amount capitalized. And a mental checkpoint here is that any capitalized interest is equal to interest income minus any reinvested income. Let's move on. accounting versus tax, and deferred tax. Finally, let's deal with the accounting versus taxation. For the accounting treatment, borrowing costs are capitalized to the asset. They are not expensed immediately. They just flow to the profit or loss over time through depreciation. Now for the tax treatment, interest is deductible earlier under tax rules. Capitalization interest does not increase the tax cost of wear and tear. The difference creates a temporary difference, which links to IAS 12 deferred tax, which we will be covering in future episodes. So a mental checkpoint here is that accounting and tax treatment of capitalized interest is different, and thus deferred tax arises. Now let's bring it all back home. In exams, don't memorize the wording of the standard. Remember the walk. Ask yourself, is this a qualifying asset? Is construction actually happening? And has the process started, paused, or finished? If the answer breaks at any point, the borrowing cost goes straight to statement of profit or loss. Picture the builds, follow them in order, and the treatment becomes obvious. That was borrowing costs under IAS 23. Thank you for watching. See you in the next one.